Hi and welcome to today's webinar. I am going to show you, I'm going to tell you, and I'm going to explain to you very basic stuff of trading. I'm going to show you and tell you what a currency pair is, a pip is, a lot size is, the cost of trading, and margin leverage, basically your risk. Right here, right now, in front of you and me, we have Euro USD. Also here, the euro against dollar. Since the euro is on the left side, the euro is on the left side of the currency pair. That is the base price. Okay? That's the base. And then the American dollars is, in this case, the quote price. So if you take another currency pair here, for example, dollar on the other side, USD CAD, then USD in this case is then the base price, and then the CAD is the quote price. So how does this go? How do you know the value of a currency? You then see that since the euro is on the left side here, that's set to 1, that's standardized to 1. So to get 1 euro, you have to have 1.1621 American dollars. Okay? Basically. And if you want to buy the euro USD, you have to have fundamental buys that is actually going up, that euro is going up and dollars going down. As you also can see here, this is the bid price. That is the sell price you have been given by your broker. In this case, it's FXCM. They will give me a price of 16.21 current market price. It was at least on Friday. And then the ask price is the buy price, and that's what they will offer me. That's where, if I enter a trade at market price, that's what it will show. So between the market price and the price that the broker gives me is a spread. What is a spread? The spread is basically the small amount of money that your broker takes from you when you want to enter a trade. It already sets you back. Sets you back basically when you enter a trade, so you have to move some pips into profit to regain, to be break even. Okay. And then this spread is variable. It depends on the volatility, the fluctuation of a price, because at some point there can be an election, there can be news, it can be fundamental news, it could be that the Americans are putting up their interest rates to the banks. That will increase the spread, and that basically means, since the spread is then wider, that means that you have to move more pips in the direction of your trade to become break even again. Okay, so spread is really bad for you, so you shouldn't really trade in volatile market, because it sets you back even further. Well, if it moves 1,000 pips in your favor, and 20 pips might not be such a big deal, but it is a big deal if it only moves 100 pips in your direction, and you're already 20 behind. That only give you 80. Well, that's one thing, but I wouldn't. And then that is a cost of trading. The price also comes with cost of trading, the spread, and then that's variable, and then the fixed is commission. Okay, commission is 0.04 with a micro lot, 0.01. For all the major currency pairs, 0.04 American US dollars per 0.01 lot size. Okay, so if you have one lot, trade size, you then would pay $4 for the majors. Okay, but then for all the other currency pairs, you pay 0.06 per micro lot. So what is a lot? A lot is basically the amount that you're buying of one thing. Okay, so as I mentioned, 0.01 is the same as 1,000 units. Okay, so 1,000 units, when you place a trade, you buy 1,000 units of the euro. If you buy 1,000 units of the euro, and you sell the American dollars with 1,000 units. Okay, and then with one lot, 1.000, if that's better for you, then that equals, and that's times 100, so that's 100,000 units. And again, if you buy EURUSD, you buy 100,000 units of euro and sell 100,000 units of the American dollars. Yeah, isn't that good? We all understood what that meant. The other thing is, as I mentioned, cost of trading, actually, to be honest. I don't like it. It's a way for brokers to make money. I guess they also have to be alive. It's a business for them too. But do I like it? No, I don't. And they have initiatives, or they want you to trade as much as you can, because then they can get your commission and get your spread, variable spread. And how to get away from the variable spread. At least the broker that I use right now has fixed spread, and I pay commission instead. I guess it's higher. Well, I think that's better than to start with the micro lot, the minimum lot. I start with $0.04 in loss. I don't like that. Yeah, and then per pip. Okay, so here we go again. So 0.01 lot size. That equals with EURUSD. That's in terms of money. 1 pip is $0.1. Okay, go to just Google pip value, calculate pip value. There's different pip values from different currency pairs. I can't remember everyone because they also change every day. Or does it? I don't know. So there's different value for different currency pairs. So check that out. Either FX Street, Forex Factory, whatever. There is plenty of calculators out there of how to calculate your risk, calculate your pip lot size, and etc. And then, since we then are talking about things that we need to know, margin. When you open a trading account, it says margin at the bottom of your trading terminal. What is that? Margin is really the minimum amount of money you need to have in your account at any given time for your positions to be open. If not, you will get something called margin call. There is no difference between your equity and your margin, and all your trades will be closed out. There's no more money. You're basically blowing your account. Never, ever, ever go there. I don't like it. Have I ever gone there myself? maybe, but don't do it. Because if you do that with a $100,000 account and you go to margin call, oh, that's a lot of money. That's a yearly salary for someone. Give it to charity instead of risking it. And then, yeah, so margin call basically takes out all your trades, open trades, good trades, bad trades, all your trades. Trades are still trades. What you then do is, how do you then not get a margin call? One, you have appropriate risk. You go to with those websites, you say, I want to trade EURUSD. I want to have a risk of 2%, which I would recommend. You have 1,000 lots, no, 1,000 units or 0.01 lot size. Then you come out with, okay, fine, Then you come out, yeah, okay, fine. You can also calculate what your lot size should be. So it will tell you whatever, depending on also about your equity in your account. So how to not get margin call? One, to manage your risk, as I said. Then your leverage. When you open an account, you can place your own leverage, what you want. I have 100 to 1 or 1 to 100, depending on what you say, how you say it. I don't know, I don't care. It doesn't matter to me. That's basically, the closer to 1-to-1 ratio you go, the more money you need in your account, in your equity, to sustain your current positions. Okay, that is very important to keep, so you can trade forever. So I have 100 to 1, which basically means that if I place a 0.01 lot trade, here it is. If I place that, then I only need, that's 1,000 units, and my stop loss is 100. That leaves me to $10. Oh no, not 1,000 pips. Okay, if I have 1,000 units, that's my lot size. My leverage ratio is 100 to 1. That means that I need my margin, and my leverage is then, no, my margin is then $10 that will be taken out of my account, set aside to sustain the account. Good, fine. But then if you then have, there you are. If you then have 100,000, which is one lot, and you have 100 to 1, that means that you need, at any given time, minimally 100,000 US dollars in your account. So the higher leverage ratio you have, the higher, 200, 300, 400, whatever it is, the less you will need to risk into the market, the less and the more likely you are to survive in the market, because the less risk you take, funny enough, is the more likely you are to be profitable, because then it will take you longer time to make all those mistakes that you do in the beginning, and you will be staying long in the game, and then 10 years from now you will be profitable, you will be making money. But if you used too high risk, too low leverage ratio, you'll be taken out tomorrow. Okay? And I don't want that. I want you to succeed. I want you to survive. So please manage the risk. Please have, okay, I can advise you to 100 to 1. You can choose something else. And keep your lot size low compared to your equity, so that you don't get margin call, basically. I hope this video was valuable to you. Please like, comment, and I will try correct my mistakes in the next future videos. Have a great day.